So what if I told you that right now, as you watch this video, there is almost certainly one mistake that you are making with your pension, and that the difference between fixing it and ignoring it is roughly 5 years of your life. Not 5 years of saving harder, not 5 years of earning more, 5 years of your actual retirement, 5 years of mornings where your alarm is optional, 5 extra years of doing whatever you want, whenever you want. And the crazy part, the fix is so simple. It's not complicated. It does not require a financial degree. It just requires you to understand one thing that your pension provider is almost certainly not telling you. So stay with me, because by the end of this video, you're going to know exactly what to do. Let me start with a question. When you joined your current job and you got enrolled into your workplace pension, I'm sure you genuinely can remember that happening. Did you actually choose where your money was invested within that pension? If you're like the vast majority of people that I speak to, the answer is no, you didn't. You got enrolled, you started seeing a deduction on your payslip. Maybe you saw your employer chip in a little bit on top too, and you thought, great, sorted. That is my pension dealt with. Tick. But here's what most people do not realize. When your money goes into that pension, it doesn't just sit there in a bank account. It doesn't just sit there gathering dust. It gets invested immediately into something called the default fund. And that default fund, the thing that you never chose, never even looked at, and probably couldn't even name right now, is the single biggest factor in determining how big your pension pot will actually be when you eventually retire. Think about that for a second. The investment doing most of the heavy lifting for your retirement was chosen for you without your input, based on absolutely nothing specific to your life or your goals or your circumstance. That is the mistake. And it's costing millions of people years of their retirement without even knowing it. Now, to understand why this matters so much, I need to explain something to you really, really quickly, okay? And I promise this is way simpler than it sounds, okay? When it comes to investing, whether that's in your pension, in your ISA, or anything, you should think of your money like a chest of drawers. Now, that chest has basically 4 drawers that you can put your money into. Drawer 1, the top drawer, that's equities, your stocks and shares. This is where the biggest returns live over the longer term. Historically, the stock market has delivered the highest growth of any asset class. But, and this is important, this is a complete roller coaster on the way up, on the way there. Huge ups, huge downs, not for the faint-hearted in the short term. Drawer 2 is what we call fixed income. That's things like government and corporate bonds, loans to companies and governments like IOUs. Much lower returns than equity over the long run, but a much, much smoother ride with less dramatic swings. Drawer 3 is kind of, you can group it any other way, but in this case, I've gone with alternative. Things like property, infrastructure, commodities. These can vary quite a bit, but they generally don't return as much as equities, certainly not with any positive expectancy, and they can move in all sorts of different directions. And drawer 4, this is the bottom drawer, is cash. Safe in the short term, absolutely, but over time, inflation quietly erodes it. Cash in a pension over 30 years is not a strategy, it's a slow leak. Now, why do these 4 drawers matter? Because basically, they behave differently from each other. In financial terms, they have what's called low or negative correlation. Now, in plain English, that just means that when one goes up, the other one goes down, kind of. It's never perfect, but that's the correlation between the two. Here's the right way to think about it, okay? Imagine you're selling umbrellas and ice cream. If you only sell umbrellas, you do brilliantly in the winter and terribly in the summer, right? If you only sell ice cream, it's a complete opposite. But if you were to sell like 50-50 or sell both, you would smooth out that whole year. You're never having a catastrophic season because one product is always picking up the other one's slack. That exactly is how these 4 investment drawers work together. The skill, and kind of what everyone is trying to achieve, is to blend those drawers in the right proportion so that the overall portfolio keeps growing steadily without being wiped out by a single bad season or you getting in the way of it effectively. Now, the key question is, how much of your money should you put in each individual one of those drawers? Well, the answer comes down to two things: your attitude towards risk and your time horizon. Okay, they are the absolute two most important things. Your attitude towards risk is simply, how do you feel about your money going up and down? Are you someone who, if their pension dropped by 20% in a market crash, would just shrug it off and stay the course? Or would you lie awake at night in absolute cold sweat because you can't handle it? There is absolutely no right or wrong answer here. Both types of people exist, but it matters enormously, to be honest. Your time horizon is probably even simpler and sort of less subjective. The answer is, how long until you actually need that money? So, for example, if you're 25, you might have 35, 40 years before you can access your pension. If you're 55, you might have 10 or whatever it is in terms of your time horizon. Here's how to use both of them together. Give yourself a score from 1 to 10 on risk. Which one is where 1 would be, I cannot stomach any volatility at all. I don't like seeing my money going up and down. And 10 is, well, I genuinely don't really care if it drops by 40% in the long term. In the short term, I'm in it for the long haul. So then give yourself a second score from 1 to 10 on time horizon, where 1 is I'm retiring next year, and 10 is, well, sorry, I'm in my early 20s and my pension is decades away. So you have those two numbers, attitude towards risk and time horizon. Now, generally speaking, what you need to do is add those two together and average them out. That should give you a rough guide as to where you're at. It's certainly rough and it's a blunt tool, but it's a useful starting point for the level of risk that you should probably take in with your pension. Now, let me give you some real examples to kind of see how this might work for you. Let's say you've got a super cautious and nervous 25-year-old. They score themselves on an attitude towards risk of 5 out of 10. Not wild, not panicky, just middling. But on a time horizon, they're obviously a 10, right? They've got decades ahead of them to invest. If you average that out, you're looking at somewhere between, let's say, 7 or 8 out of 10. Meaning that they should probably be taking on more risk than their gut instinct tells them to, because time is their superpower. Now, if you flip that, let's say we've got an adventurous 52-year-old. Now, they could call themselves a 9 out of 10 on risk. They love a punt, never panicked during a crash. But on the time horizon, they're more like a 4 or a 5 because they're getting closer to the point at which they need to access that money. So again, if you average that out, what are you looking at? You're probably looking at like a 6 or a 7. Still fairly adventurous, but the time has started to work against them a little bit more. So a little bit more caution is warranted. Now, look, you're obviously getting the point here that this is not an exact science, but this framework gives you a starting point that is definitely more personalized than anything that your pension provider has done for you. So here's the issue. Your default fund, the one that you're probably in right now, was not built for you specifically. It was built for everyone, every person in your company, every age, every risk tolerance, every timeline, all lumped into that one default option. And what happens when a pension provider needs to design a fund that works for a 22-year-old, a 45-year-old, and a 63-year-old simultaneously? Well, obviously, they play it safe, right? They go straight down the middle. They pick a balanced allocation, not too aggressive, not too cautious, that hopefully doesn't cause anyone any big complaints or concerns. So on a scale of 1 to 10, where cash is 1 and the global stock market is like a 10, most default funds will sit somewhere around 5 or 6, right? Pretty balanced, pretty middle of the road, also pretty vanilla. Now, that isn't catastrophically bad. A 5 or 6 out of 10 fund will still grow over time. It will still give you some growth at the end. But the question is, is a 5 or a 6 out of 10 actually right for you? Because if you're a 30-year-old with a high risk tolerance, then you are almost certainly leaving serious money on the table by being in that default fund. And when I say serious money, I genuinely mean it, right? Let's put some numbers on this, because this is where it starts to get pretty real. Assume that you're in a balanced default fund that returns on average, let's say 6% a year. Fine, pretty decent, nothing wrong with that. Now, imagine that by making one simple change, shifting from a fund that has a little bit more stock market exposure, equity exposure, a little bit more in that top drawer that we mentioned, you nudge your annual return up to around 8% on average. Now, 2% sounds pretty modest, right? Doesn't sound like a huge amount of money, but over 10 years, that could be meaningful, but maybe not life-changing. Over 20, now we are talking. Because over 30 years on a pension pot, that 2% difference compounds into a staggering gap. Staggering. We're talking about potentially tens of thousands of pounds difference in your final pot size. For some people, that is a 6-figure difference. You can see here that based on £500 a month, which is pretty average in terms of pension contributions, over 30 years, that difference is over £243,000. Crazy, right? That could mean the difference between retiring at 65 or 55, retiring 5 to 10 years earlier with a larger pot, funding a longer and more comfortable retirement. I genuinely believe, and this is not a throwaway line, that 90% of people in workplace pension could retire meaningfully earlier if they just took the time to understand where their money is invested within their pension, work out what their actual risk profile is, and then move into something that fits them properly. 5 years of your life for what? An afternoon of reading pension documents. It's really not that much to ask. Genuinely, I think this is the single greatest needle moving exercise that you can do with your finances. So, what do you actually do with all of this information? Okay, let's have a little look. So, step 1, find out where your pension is invested right now. Okay, log into your pension provider's portal. Every major provider, whether it's like Nest or People's Pension, Aviva, L&G, Scottish Widows, whoever, they will have an online account. So get your login, find out what fund that you're currently in and just write down its name or something like that. Step 2, try to work out your risk score. Okay, use the blunt tool, the framework that I gave you earlier. What is your attitude towards risk? 1 from 10. What's your time horizon? 1 from 10. Average them out. Now you've got a rough target. If you wanted to be a bit more precise, I actually have a really handy risk profile app that you can use to go a little bit deeper on this. It's completely free to use, and you can find it in the link in the description of this video. So give it a whirl. It'll give you a really, really good insight into what level of equity risk you may want to take. Now, most providers will give you a range of alternatives that you can switch into. So the next thing to look out for is essentially looking at the options that are available to you. So you're going to want to look at things that are labeled things like, if you want to take a little bit more risk, you'll want to look for funds that are like adventurous, dynamic, aggressive, or even at the top end of the scale, things that just say 100% equity or global equities or global stock market fund. If you want more in that top drawer exposure, that's the type of fund name that you're going to look out for. If you want to go slightly more cautious, you look for names like balanced or cautious. They'll generally give you kind of what you're looking for. Now, step 4, check for the charges, okay? Fees might seem small, 0.2% here, 0.5% there, but over decades, they compound just like returns do. So make sure that any fund that you move into isn't necessarily costing you significantly more than your current default fund. If it does, yeah, that extra return may well potentially be eaten up in charges. Now, step 5, the final step, make the switch. Okay, most providers will let you do this entirely online in about 5 minutes. You don't need to call anyone. You don't need a financial advisor to do this for you. It's just a basic step. You log in, select your new option, and confirm. Now that is it. 5 simple steps, potentially hundreds of thousands of pounds of difference, and potentially 5 to 10 years of your life back. Look, I'm not saying that everyone needs to go out there and load their entire pension into the most aggressive fund available. That is not the point of this video. The point is that your pension is probably invested in something that was never designed with you in mind. And for a huge number of people, that means that you're taking less risk than you actually should be, missing out on returns that over a lifetime of savings can make an enormous difference to your life. Your pension is not just a direct deduction from your payslip. It's an investment, so start treating it like one. Give it the same thought that you'd give to any other important financial decision. Understand what it's invested in, understand whether it suits you, and if it doesn't, change it. Because the single most expensive thing you can do with your pension is nothing. Now, if you do all of these things, one of the problems that you're actually going to face is knowing when to actually stop and step off the hamster wheel of just paying in and growing your pension, which is why you should really watch this video here next, because I'm going to show you exactly the point at which you should stop saving money. So give it a click, because there is a certain point in your life where saving additional money just does not make any sense anymore. So I'll see you there.